Hey everyone, welcome back. This is Kirk here again at optionalpha.com. And today we had a pretty active day in the market. And we're going to go over all of our opening, closing, and or adjusting or rolling trades today. And I actually want to start out this video by going over the SLV, which is the silver ETF roll that we had. So it's one of the more interesting trades that we've had because it's a trade that is continuing to roll on from May of this year. So it's a trade that we rolled from May to June. And now here we are again. We're just kind of on the cusp again of getting the expiration and going to roll this trade again from June to July. So it's a trade that's pretty much dragged out for the better part of 2.5 months. But hey, this is what trading is all about. It's about keeping the dream alive, at least with this trade. And it doesn't make sense right now to either close it out or kind of wait. We're still on the dance floor here with SLV. So we don't want to make that kind of coin flip bet right at the end of expiration where we could lose a ton of money or really make a ton of money right near expiration. So the best thing we can do now as we're starting to head towards expiration is go ahead and roll this trade out. We paid a small 5-cent debit to roll it out. So at the end of the day, our total cost after all the rolls and getting into it is about $115. So really not that big at all. About a 5-cent debit is about as cheap as you're going to do to roll this trade out to the next month. And basically, we buy another month of time to be right in this directional trade in only 5 cents. So it's not that big of a premium. But again, what we did is we went ahead and rolled. That's why the alert says vertical roll and the SLV, and we rolled out to July from June, all staying in the same strikes. So we kept the same strikes, the 18-20 call spread, debit call spread. And again, this particular roll only cost us 5 cents in debit. So the cost of closing out the June plus re-entering a new July, that difference was only a 5 cents debit. So very, very cheap to do that. With the total premium that we've invested in SLV after 2 rolls of about $115, that brings our break-even price to about $19.15, so a little bit over 19. Now, if we go to the chart of SLV, you can see that pretty much since we entered the trade back in April, we really wanted kind of 19 to be that area that we wanted SLV to trade above. And at the end of May, when we rolled it to June the first time, it was kind of flirting with that area, right? And actually didn't trade above 19 at the time. So it's actually good that we rolled that option out. Now, all of June, SLV has stayed pretty much a loser until just recently where it started to come back towards 19. So this line that I'm drawing here on the chart, that's kind of our line in the sand. This is really where we want SLV to close above right now for July. So now that it's starting to come back just a little bit, that gave us the opportunity to, again, extend our duration. Now we have July expiration to look forward to. And now we've just moved our line in the sand up just a little bit. But again, we've got a little bit more time to be right in this trade. If at the end of the day, we're not right in this trade and SLV continues to trade lower, at least we bought another 30 days of time for about 5 cents. About as cheap as you can buy premium in time. Now, a lot of people had questions today, and I had a couple coaching students that had called me and said, Kirk, you always said that you shouldn't really roll unless you roll for a credit. And that's true only in the case of credit spreads. So if you're rolling a credit spread from 1 month to the next, yes, you do want to take in additional credit because you're taking on additional risk by rolling that trade to the next month. In this case, with debit spreads, you usually have to roll for basically a par price or a debit, meaning that you have to pay a premium to get out to that next month because you're basically buying more time in the future. So it's a little bit confusing, but again, with debit spreads, it's okay to pay a little bit in debit. You don't want to pay too much, right? Anywhere around 5, 6, 7 cents is pretty much on the high end of the range of what I'll pay. 5 cents is generally just a round number that usually options trade at, so it's pretty easy to get that fill in here today. But with credit spreads, yes, you do want to take in a credit on that roll. You don't want to roll out to another contract month without being compensated just a little bit for the additional risk that you're taking. All right, so let's just move right up the chart here and we'll talk about our closing trades. So the first one that we had today is Dow DOW. Now this was a call spread that we had originally sold. It was the 49.50 call spread, and we bought it back today for pretty much max loss, which is $98. So we took a $65 loss on each of these trades. Now this is a great example of a trade that you really can't roll out to next month. It's just already too far in the money, and it's just a trade that goes against you. It's just a trade that you didn't pick the right direction. That's what ends up happening. So we had the 49.50 call spread, which basically puts our first line in the sand all the way down here at 49. And you can see the stock is well above that price point and likely not to get back. So at this point, since we're so close to the expiration, we got to start rolling off some of these trades. Don't use my terminology the wrong way. We're not rolling them to next month. Sorry, start closing out some of these trades that we don't roll and just getting out of them, because since it's in the money right now, we're at risk of being assigned. And not to say that that's necessarily a bad thing, but it just eats up a lot of commissions to be assigned on this type of a stock. Now, if we were to pretend that we were going to roll that trade out to the next contract month, this is where, again, we just look at the next contract month of July, and you can see that rolling to the 45.50, if we were to sell that vertical for the next month, we would only get a 14-cent credit. So that's not even including the fact that we had to buy back our current spread. So if we look at buying back our current spread at 98 cents and then getting a 14-cent credit for that, it just doesn't make sense to do that. So it just doesn't work out. So this is too far gone already. The best thing you can do sometimes is just close out the position. Don't compound the loss by rolling out and taking in basically a debit instead of a credit. All right, the other trade that we closed out today was a nice little winner, and that was USO. We've only had this trade for a couple weeks now, and it was just a vertical call spread, so we're playing directionally a move up in USO and oil. We had the July 37.39 calls, and we closed that out today for a 130 credit, so it took in a $28 profit on this. Again, since it's more of a directional trade where we entered the spread, at about $1 in credit, we actually don't really need to see a huge move in the underlying. It's originally a 50-50 bet, so once we see anywhere between a 20 and 25% of max gain reached, and that's about $25 or so that we're looking for, then we actually want to go ahead and just close out that trade because it could roll over on us. So again, USO just made a nice little move higher. That's exactly what we were expecting, and you can see it just kind of popped here just today, which helped really expand this trade, and it made a nice move higher, and that's really what we want to see. We want to see that move higher. Implied volatility jumped up just a little bit. So again, had a nice opportunity to close out the trade, which we did today. All right, so the last trade we want to go over tonight is the opening trade in Amazon. Now this is a butterfly spread, and I'm going to go over this one just a little bit slower because it is a broken wing butterfly, and we have traded these before, but again, it's a little bit different than your average butterfly, so I want to take my time with this so you guys completely understand what we're doing. So even though the alert says that we're buying, because that's typically what you do with the butterflies, you buy a butterfly, and again, with a regular butterfly, not a broken wing, the strikes are evenly spaced apart. So in this case, it would be the 340, 345, and 350 if it was a regular butterfly. But notice that these two strikes are about $5 apart, but this last strike over here, this 355, is $10 wide. So it's about $10 from the 345 strike. And that creates our broken wing butterfly. So that creates the profit loss diagram that looks a little bit different than just your regular butterfly. Now, by going out that extra distance and kind of skipping over the 350 strike, we're able to then buy that 350 call for a cheaper price, which then allows us to take in a net credit on this trade. So by taking in a net credit, that's really key for these broken wing butterflies, is you want to take in a net credit, because what that does is that allows you to have absolutely zero downside risk. And actually, in this case, if Amazon completely falls apart, then we actually keep that $60 credit, which is ideally what we want to do, right? And there's an opportunity here to actually make more than $60 in credit, but really, if Amazon falls apart and goes all the way to zero, with this broken wing butterfly, we actually get to keep a $60 credit. That would not be the same with a regular butterfly. All right, so let's take a look at the chart here of Amazon. And you can see that the stock has been in a nice rally here recently, but then just the last couple days, we actually tried to enter this order yesterday, but just didn't get filled. The last couple days, the stock has started to really kind of turn over here a little bit, and that's what we're really expecting. We want to see Amazon either continue to trade about sideways or lower. That's ideally what we're looking for with this broken wing butterfly, is Amazon to trade either sideways or to continue to trade lower as we get towards July expiration. So as we look at the actual Analyze tab here of Amazon, so you can see exactly where our strikes are positioned, you'll notice here that Amazon is trading right now at 325. And again, if you don't know how to use the Analyze tab, we've got a great video tutorial for you guys right inside the membership area. We go over it. I think it's about a 30-minute video tutorial, so go ahead and check that out. But again, you see that at this price point, we have this broken wing butterfly. Amazon's trading at $325. And notice that the kind of peak in our butterfly pattern happens all the way up at $345. So that's ideally where we want the stock to sell. That's the premier point. Even if Amazon rallies all the way up to $345, we still have an opportunity to make some money on this trade. Now, by taking in a credit, we basically make that 60-cent credit anywhere below our first option here at 340. So you notice our first strike is at 340. And by taking in a credit, you see how the profit loss line kind of flattens out anywhere between 340 and down. Now that allows us to take in a credit no matter where Amazon goes. So this is a great trade because it gives us such a big window of opportunity to make money. We basically make money on Amazon so long as it trades below 350 by expiration. So we've given ourselves $25 of potential move up in the stock and still have an opportunity to make money. If Amazon stays right where it is, we still make money. If Amazon falls completely to the ground, we still make money on this trade. And this is a great high probability trade to be making. Now that broken wing side of the trade is on the right side of your graph here because we skipped over the 50 strike. So we go past the zero barrier here, and then we hit the 55 strike, and that's where, again, the profit loss diagram kind of flattens out. So this side of the trade is your broken wing side of the butterfly spread. If we go back to the graph here just before we end, you can see that we've given ourselves all the way up until 350 to make money on the stock. So really that is our huge line in the sand. We give ourselves enough room for Amazon to rally a little bit more, but really ideally we want the stock to stay below that level between now and expiration. So as always, I hope you guys really enjoy these videos. If you're watching this video on YouTube publicly somewhere, you just have to understand that you're not getting these trades and these videos at the same time as our members on our website at optionalpha.com. So go ahead and check out our website, sign up for the 7-day trial. You'll get all of these video tutorials and alerts the same day that they're sent out. As always, if you have any comments or questions, please ask them right below this video. I'll get back to all of those tonight or tomorrow before the open, and happy trading.